Are you aware of the new crypto regulation proposal that's causing quite a stir in the crypto world? Let's dive into it. President Joe Biden has recently proposed a new regulation, a part of his fiscal 2025 budget, that could potentially reshape the cryptocurrency landscape. Two of the key features of this proposal are stirring up conversations. Firstly, there's a new excise tax on crypto mining. This tax is not a sudden imposition. Rather, it's proposed to be phased in over 3 years, starting at 10% and climbing up to 30%. The aim? To address environmental concerns and generate revenue, with a projected intake of $302 million in the first year alone. Secondly, the proposed wash sale rule for cryptocurrencies, an attempt to target market manipulation. This rule, already in place for stocks and securities, prohibits selling an investment at a loss and then buying it back within 30 days. With such a significant proposal on the table, one might wonder, what are the implications? Let's delve into the first key point of the proposal, the crypto mining tax. To understand the impact of this proposed tax, we first need to grasp what crypto mining is. In the simplest terms, crypto mining is the process of verifying and adding transactions to a blockchain, the public ledger of all past transactions. It's a vital part of the crypto ecosystem, ensuring the integrity and security of digital currencies like Bitcoin and Ethereum. However, this process isn't without its challenges. Mining requires a significant amount of computational power, which in turn consumes a substantial amount of energy. This has led to increasing environmental concerns, which is where President Biden's proposed excise tax on crypto mining comes into play. This proposed tax isn't just a random shot in the dark. It's a calculated move designed to address these environmental concerns and create a new source of revenue for the government. The tax is set to be phased in over 3 years, starting at 10% and gradually increasing to a hefty 30%. Now you might be wondering, just how much revenue could this tax generate? The numbers are quite staggering. Initial estimates suggest that this tax could bring in $302 million in its first year alone. And over the next decade, we're looking at an estimated total of $7.7 billion. That's billion with a B. But as with any proposed tax or regulation, there's always a flip side. This proposed tax also raises questions about the future of crypto mining. Will it discourage new miners? Could it potentially lead to a decrease in the security and integrity of our beloved digital currencies? Or perhaps could it spur on innovation in the sector, leading to more energy-efficient mining practices? While these questions remain unanswered, one thing is certain. If implemented, this tax will bring about significant changes in the crypto landscape, particularly for those involved in mining. While the mining tax could generate substantial revenue, it also raises questions about the future of crypto mining. Moving on to the next key point, the wash sale rule. Now, what exactly is this rule, and why is it causing such a stir in the crypto world? Let's break it down. The wash sale rule is a regulation that prevents investors from selling an investment at a loss and then immediately repurchasing the same or a substantially identical investment. Essentially, it's a rule designed to stop investors from creating artificial losses to offset their taxable gains. In the traditional financial markets, this rule has been in place for some time. For instance, if you own shares in a company and sell them at a loss, you cannot buy back those shares or a substantially identical stock within a 30-day period before or after the sale. If you do, the loss from the sale is disallowed for tax purposes, and the cost basis and holding period for the repurchased stock are adjusted to include the disallowed loss. Now let's bring this into the context of cryptocurrencies. Currently, cryptocurrencies are not subject to the wash sale rule. This means that if you sell your Bitcoin at a loss, you could immediately repurchase it and then use that loss to offset your taxes. The proposed wash sale rule for cryptocurrencies aims to change this. It seeks to bring parity between the treatment of losses in the crypto market and those in traditional financial markets. The hope is that this will help prevent market manipulation and provide a fairer landscape for all investors. However, it's important to remember that the crypto space is a different beast altogether. Unlike traditional markets, it operates 24 hours a day, 7 days a week, and it's characterized by high volatility. These factors could potentially influence how effective the wash sale rule would be in this space. Moreover, the application of the wash sale rule to crypto could also raise complex questions about what constitutes a substantially identical cryptocurrency. Would Bitcoin and Bitcoin Cash, for example, be considered substantially identical? These are questions that would need to be addressed for the rule to be effectively implemented. In conclusion, the wash sale rule could be a significant game changer in crypto trading, but its effectiveness remains to be seen. So, what does this all mean for the crypto world? Firstly, for crypto enthusiasts and investors, the landscape is about to change. The proposed regulations would introduce a new level of oversight and taxation that could impact the profitability of certain activities, such as mining. The phased-in excise tax, starting at 10% and reaching up to 30% over 3 years, could potentially make mining less profitable. This might lead to a reduction in the number of miners, which in turn could affect the overall health and security of various crypto networks. For traders, the wash sale rule could change the game. This rule, if implemented, would prevent them from claiming losses on a crypto sale if they repurchase the same crypto within 30 days. This could drastically alter trading strategies and may cause a shift towards longer-term investment approaches. But it's not just the crypto enthusiasts feeling the heat. The proposed regulations have ignited a fierce debate across the political spectrum. Republicans have voiced strong criticism, arguing that these regulations could stifle innovation and push crypto activities offshore to less regulated jurisdictions. Yet, amidst the debate, one fact remains clear: the final form of these regulations is uncertain. The proposal is just that, a proposal. It's still subject to change and negotiation, and with such a divisive issue on the table, those negotiations are likely to be intense. The impact on the crypto world could be significant, but it's not all doom and gloom. Some believe that regulation could bring more legitimacy to the sector, attracting more institutional investors and paving the way for broader adoption. On the other hand, others worry that excessive regulation could stifle the very innovation that makes crypto so unique. As we await the final form of this proposal, the crypto world is left in anticipation. Crypto regulation is a complex issue, and this proposal is no exception. This adage rings true as we delve into President Biden's fiscal 2025 budget proposal, which introduces new crypto taxes and regulations. The proposed excise tax on crypto mining, starting at 10% and eventually reaching 30%, is a game changer. It's designed to address environmental concerns and generate revenue, with predictions of raking in $302 million in the first year and a whopping $7.7 billion over a decade. Then there's the proposed wash sale rule for cryptocurrencies, targeting market manipulation. But remember, this proposal is just that, a proposal. It's faced criticism, and its final form is still up in the air. Federal Reserve Chairman Jerome Powell remains optimistic about the economy, citing low unemployment and decreasing inflation. As the world of crypto continues to evolve, so too does the landscape of its regulation. Stay tuned for more updates on this unfolding saga.